Hello. Hello to you all and welcome to this webinar on sustainable securities lending, the next greenwashing scandal in the making, organised by Solactive and Minerva Analytics. This is the first in a series of 3 webinars from Solactive on the subject of securities lending. I'm Bob Currie, editor of Securities Finance Times and group editor of its sister publications. And joining me today, I have David Crum, managing director for Asset Steward Solutions at Minerva Analytics. We have Rajek Stech, Chief Executive of Global Principles for Sustainable Stock Lending. And we have Roy Zimmerhansl, Practice Lead at Pierpoint Financial Consultants. Just a bit of housekeeping. We encourage you to be active in shaping this discussion, so please do ask your questions. You can do so using the question box below. I'll try to remind you a couple of times in the course of the discussion, but please do get your questions in. The focus on sustainable finance is gathering momentum, building on initial foundations laid down almost 30 years ago at the Rio Summit in '92 and through the Kyoto Protocol in '97, among other early initiatives. It's been something of a winding road to get to where we are today, but financial services has made considerable progress over the last 5 to 10 years in promoting sustainable finance objectives. That is in the investment decision-making process, but also clearly along the entirety of the transaction value chain, including securities lending. And that is clearly the intention. It shouldn't just be the investment decision-making process, but should extend along the front-to-back value chain. This webinar focuses on the nexus between securities lending and sustainable finance. It explores the idea that securities lending provides an important contributor to market efficiency and liquidity, but also that securities lending has a role to play in supporting actions that challenge greenwashing. For example, by supporting activist short sellers that are looking to hold to account companies that do not embrace strong environmental and social values. Is greenwashing a problem? Well, the securities finance community seems to be telling us that it's certainly on their watch list. In the summary report published by ICMA, the International Capital Markets Association's European Repo Council, which many of you will have seen, published this week, which presented the preliminary findings of its consultation on the role of repo in sustainable finance. 59% of respondents to that process identified greenwashing as being top concern when they were asked to identify the greatest possible risks linked to the growth of a green repo market. That in respondents' eyes took various forms. Respondents were concerned particularly about risks associated with incorrect classification of products as green investment. Another facet that was raised on a number of occasions was the problem of double counting of the benefits delivered by green repo, where no additional green assets are created throughout the transaction and no additional funding goes into green activities, but both counterparties are claiming the green collateral as part of their commitment to green investment. So this is some of the things that we will touch upon in a broader context when we start to investigate the nexus between sustainable lending and sustainable finance. I'm now going to hand over to our panelists to share some of their initial thoughts on these pressing issues. And I'm going to do so by starting with Roy Zimmerhansl from Pierpoint Consulting. So I'm going to pass over to you now, Roy.
Thanks very much, Bob. Again, I'm Roy Zimmerhansl, Practice Lead at Pierpoint. You know, I've been talking to investors about securities lending for about 35 years. I see sustainable securities lending as just part of the natural evolution as participants become more sophisticated and increase their understanding of the business. My role today in this opening segment is to give you a little bit of context as to why this is relevant, timely, and why you should care. Right. So why should you care? When you consider that every day there's about 28 trillion euro of assets available for loan, the scope for asset transfer is huge. Now, securities lending is a critical part of the financial markets. It's essential to liquidity for market making, for price discovery through short selling and arbitrage, mobilization of collateral for bilateral and cleared market exposures, and of course, securities lending is used to resolve potential failed trades, so it also improves market settlement efficiency. Now, the 2.6 trillion of assets on loan comprise about 1.2 trillion of government bonds and about 980 billion euro of equities, with the remainder being corporate bonds and other assets. Now, those fees on loan generate, or those assets on loan generate fees of about 3.8 billion euro, and that was just the first half of 2021. Now, it's important to remember that these fees accrue to investors that typically have very long time horizons, so accumulation of fees year after year, and that's in rising markets, falling markets, or even flatlining markets. Now, the bottom line for today's topic, though, is that securities lending supports the efforts of short sellers who really are at the forefront of guardianship for greenwashing or against greenwashing. Without a robust securities lending market, activist short sellers wouldn't be able to hold companies to account. But inevitably, there's issues. And first and foremost among that is, the ESG itself is still evolving. The standards, the requirements, they're developing. And securities lending as a secondary market activity, you'd expect to follow rather than lead, or maybe at best be developed concurrently. But nevertheless, investor expectations, I think, are rising. And there's demand for continuity from the front-end investment selection through to back-end activities like securities lending. For example, if an investor won't buy a certain asset because of their ESG considerations, they shouldn't be willing to hold it as collateral. Now, that means that new attitudes and approaches are required, and change is uncomfortable, uncertain, and carries additional cost. And securities lending is unlike typical markets because an investor might be a buyer or seller of an asset, whereas in securities lending, borrowers are borrowers, lenders are lenders at the end stage. So there are times when their opinions and views are diametrically opposed. And most of the expertise at the moment is held within the intermediaries that service the end lender and end borrower, because historically, neither the end lender and borrower has really been involved or engaged in the day-to-day operating infrastructure because they haven't been needed and they haven't wanted to. But ESG is different because all of the characteristics about ESG and all of the issues associated with sustainability affect one or the other end user, or maybe both. So voting's a good example. More active voting by investors could have a detrimental effect on borrowers. Or if lenders become more selective about the collateral they accept, that might negatively impact the borrower's flexibility and costs. And so what we need are constructive, creative solutions to that, because there are solutions out there. Today, the problem is that ESG issues typically are dealt with through very blunt tools, things like exclusions. I won't lend, or negative screening, rejecting entire sectors, whereas on the investing side in the front, investors might actually be looking at it and being selective and saying, that's a good company, that's a bad company, and buy the good company. Securities lending, they just say, I don't want to have anything to do with that. And that really isn't sustainable in itself. So how do we actually move forward? Open discussion, open debate. It's all about engagement to me. And it also requires listening, because the assets belong to the lending investors. They're used by the end borrowers, and their voices, along with other stakeholders such as regulators, they need to be heard. But also associated initiatives such as green bond financing also need to have a seat at the table for discussions for their input. And this needs to be done in a positive, constructive, and creative way, because as ESG standards develop in the wider market or more narrowly within securities lending, we need to develop, adjust, and adapt solutions that are practical, they are incremental, and they're driven by a need to continuously get better rather than try to find a perfect solution, because today's perfect solution may not be adequate for the future. So what we need is a time to develop all of this. And of course, we need a positive venue. Fortunately, we have one, Global Principles for Sustainable Securities Lending, but I don't want to steal Radek's thunder. I'll just say that to me, this is the only venue that both invites and welcomes all voices from all stakeholders to share their thoughts and views. Really, to summarize, I strongly believe that without a robust securities lending infrastructure, corporate accountability will be strongly undermined. So rather than securities lending being part of the greenwashing problem, it's an essential part of the solution. But work needs to be done. And with that, I'll hand over to Radek.
Hello, my name is Radek Stech, and I am the founder and the CEO of the Global PSSL Community Interest Company. This is a very exciting and productive period of time for Global PSSL, and my objective today is to give you a snapshot of key developments so that it all makes sense for you. But before I start, I'd like to thank Roy for his excellent and insightful presentation. In terms of the beginnings, it all started in 2018 when, in London, I proposed that securities lending would benefit from a dedicated sustainable finance market standard. And I was approached by several beneficial owners with whom I established a working group that worked on the draft principles. Those draft principles were published by the newly founded ISLA Council for Sustainable Finance, and you should find those draft principles on the ISLA website. One of the key successes at that time was the fact that we had amazing partnerships with regional securities lending associations. Global PSSL itself was established in October 2020 as a community interest company and received a regulatory approval from the regulator of CICs. Immediately thereafter, the Financial Conduct Authority became our observer, and in December 2020, we published our principles for consultation. In terms of our outcomes and objectives, so Global PSSL is both inward and outward facing. So our objective is to create the global market standard on sustainable securities lending through a principles-based approach and therefore influence the securities lending market. So it's inward facing. But at the same time, we collaborate with the broader pool of stakeholders and therefore want to influence the global sustainable finance market, and we are outward facing. Obviously, by definition, we are inclusive, holistic, safe, and focused on the public interest, and we rely on the co-creation. I mentioned the principles-based approach. How can I explain it very simply? So Global PSSL, as the principles themselves, are set in context. That context is provided by international organizations such as the United Nations and the World Bank. And you can have a look at the Sustainable Development Goals, obviously. But at the same time, Global PSSL developed its own strategic themes, which you can find on our website. So Global PSSL is set in that context and also provide context for detailed recommendations and frameworks that filter through down the chain to regional and micro developments. And it's all based on feedback because we receive lots of information and feedback from many organizations such as beneficial owners, sovereign wealth funds, pension funds, agent lenders, banks, prime brokers, hedge funds, and so on. And here, this is a snapshot of our strategic themes. The whole paper is available at our website. In terms of the current agenda, as I said, this is a very exciting and productive period of time for Global PSSL, as we have recently published the revised principles alongside 17 opening signatories. When you look at the principles, you'll find that there are 9 of them, and 5 are generalist, and whereas 4 are specialist. The generalist principles should be implemented by all signatories and all organizations that care about sustainable securities lending, whereas specialist principles are implemented within organizational limits, because not all organizations engage in those specialist areas. In terms of the future, obviously we published Global PSSL, but we already think about next versions. So we are working on the revisions of Global PSSL, as this is a living instrument. We are also working on the Global PSSL mentorship program to implement our principle on inclusion and diversity. And currently we are revising and working on our recommendations on the transparent securities lending value chain, as well as several minimum forward-looking standards on short activism, interconnected collateral, and emerging markets. Obviously, we very much want to have more signatories, so we are very much focused on collaboration. Thank you so much for listening to me, and I look forward to joining the discussion. Feel free to contact me at any time.
Many thanks, Radek, for that introduction to Global PSSL, and also thanks to Roy for his introduction to the topic today. My name is David Crum. I'm the Managing Director for Asset Steward Solutions with Minerva Analytics, and I'm going to talk about sustainable securities lending from an asset owner's perspective today. So from that viewpoint, asset owners have quite a wide domain to keep an eye on. They have many things to consider, and ESG and responsible investment are areas and issues that have relatively recently popped up the priority list. So they are definitely at the top of the list. And so attention is turning to every part of an asset owner's responsibilities in terms of how they implement or include ESG and responsible investment. So securities lending doesn't exist in isolation. It needs to be included in this conversation. From many of the people that I've spoken with, who do securities lending, they view it as a marginal activity. It's helpful to have some income from it, but it's not a core function, and they would not want it getting in the way of their long-term stewardship responsibilities. So that can be seen to have been a concern for the Japanese government's pension investment fund back in December 2019 when they stopped their lending program, believing that it was getting in the way. But in thinking about lending in ESG terms, one solution might be to think about, well, let's look at the concerns that asset owners have and see if they can be addressed. So there are a couple of different ways that securities lending tends to happen, depending on whether you are a large investor, such as a large pension fund that has segregated assets, or whether you're a smaller investor, so you may be a pension fund that's investing in pooled funds, or it may be an asset manager running a pooled fund who's responsible for the lending program. So they happen slightly differently. So for larger investors, they have the option to have something that is more bespoke. It is more tailored to what they want. However, most people tend to just use the default securities lending offering provided by their custodians. So there are standard terms associated with that, typically relating to the revenue sharing that happens, that they're related to the collateral that's accepted, and these things tend to just go on in the background. So for smaller investors, there's a slightly different way of doing things. It tends to be the lending activity, the lending program tends to be built into the pooled fund that they're invested in, or the manager incorporates it in the pooled fund that they're running. The revenue terms, in terms of how the income is being split between the custodian and the end investor, is not necessarily always clear. There's not necessarily a lot of visibility on the collateral that's accepted. So you have a slightly different way of doing things depending on the size of the investor. So from work that I've done with pension schemes recently and work that I've done over my career, many investors put a lot of time and effort into developing the responsible investment approach, into considering ESG factors and how they need to be addressed in their approach to investment. But the largest asset class that most pension schemes have is listed equities, and the way that responsible investment tends to be implemented is through voting at company meetings for listed equities and engaging directly with investee companies. So lending does have the potential to get in the way of that activity, since assets out on loan, the ownership of those assets, the legal title transfers to the borrower, so the lender is not able to vote those assets, and is not even listed as the owner in terms of an engagement that they might want to undertake with the listed company. So there's things to consider for asset owners if they want to try and avoid this negative impact that lending could have on stewardship. So they could decide that they don't want to lend anything. They could decide that they want to recall every listed asset that's out on loan in time to make sure they can secure their votes, or they could try and identify which of the assets out on loan need to be recalled because there are specific issues associated with them. It's also worth touching on short selling. It might be a good idea for asset owners to think about what their position is when it comes to short selling. I've spoken with many trustees who are against it, who don't necessarily appreciate that if they're in a lending programme that they're supporting this activity. So it's certainly worth considering when thinking about ESG and securities lending. So Minerva, having worked in the voting space for many years and worked with clients on developing bespoke voting policies, are well placed to help with some solutions to some of these problems. So Minerva have developed a sustainable securities lending service for clients where we already get a daily feed of assets from custodians as part of the work we do when it comes to voting. We can get a daily feed of assets on loan from custodians and screen that against our research database. So we're looking at clients' listed equity holdings and judging them from what they say about themselves in terms of their approach to governance, remuneration and sustainability. So clients are able to specify trigger levels that would determine whether an asset needs to be recalled from being out on loan. And the service even has functionality in there to press a button to arrange for the recall. So just to sum up, the slides that I've put together today talk about how asset owners might try to help avoid greenwashing when it comes to securities lending, to make sure that any securities lending activity that they participate in or are involved in through pooled funds is more closely aligned with their responsible investment approach and their ESG considerations. So there are things that can be taken, there are practical steps that can be taken now to help improve this alignment. But I think it's important to flag up that existing service providers will need to change to accommodate this growth in client interest in all things ESG. But the potential exists in doing so to help become more risk aware and help to improve stewardship credentials for clients and also for service providers.
Thank you to all three presenters for getting us going and for sharing those interesting themes with us. I just want to broaden into questions now, and please, those people listening in, do keep your questions coming. But let's get our teeth into some of the content that our three presenters have shared with us. I'd like to start with you, David, if that's all right. And let's just pull out some core takeaways from some of the themes that you've articulated, but that have come across the three presentations in terms of how greenwashing is a problem in securities lending, but more particularly, how does that impact those that are tuning into this webinar? How does this impact their daily practice, and what are the priorities for those guys in optimizing their practice in terms of building sustainable securities lending within their companies?
Thanks very much, Bob. I mean, I think that the key takeaway I would suggest is understanding what's going on with lending, whether it's your own lending program, if you're a large pension scheme or a large investor, or whether you're invested in ETFs or pooled funds, just to find out what's going on. It's not necessarily easy to find the information. You do have to dive into the prospectuses of certain ETFs and pooled funds, and you have to, if you're me, you'll do a word search in the PDF to try and drag it out without going through all the pages. But in there's usually a fair bit of information that tells you what's going on. So I think the kind of the key takeaway is to think about, is it actually happening? And if it's happening, what's going on in the program? Do you understand how it's working and how all the different bits and pieces move?
Thank you, David. Radek, I'd like to just look a little bit at some of the practical steps that we can take to sharpen up practice in terms of building sustainable securities lending, address those practices that are suboptimal, but also put an effective forum in place where best practice can be shared across the value chain and across our industry. What are the priorities in dealing with those questions currently?
Well, I think this is a very important question. Thank you so much. I would say when we talk about a forum for sustainable securities lending or sustainable finance, stakeholder involvement is really key. And this is obviously part of our principle on stakeholder involvement, inclusion, and diversity. And now coming back to what you said at the very beginning about ICMA report and the stakeholders concerned about greenwashing. So I have a story for you because I have been an observer of green bond principles for many years, and I've been attending ICMA and green bond principles events. And back in 2016, there was a large conference on green bonds, and a day before or just on the day, WWF came up with a report which was called Green Bonds Must Keep the Green Promise. Yes, so it was quite critical of a few developments on the green bond market. And ICMA acknowledged that report on the same day in the whole forum to hundreds of participants. I found this a very important instance of stakeholder involvement, being honest about the current developments, acknowledging those developments, and being also, accommodating of those. And this is what global PSSL is about. So we rely on a so-called whole or holistic value chain, and I call securities lending as a finance dynamic, where we bring together so-called direct participants, such as beneficial owners, agent lenders, prime brokers, or hedge funds, and indirect participants, such as consultancies, NGOs, and other organizations. And this is therefore an appropriate forum to discuss and debate securities lending questions. And I just wanted to add something, because I think this presentation, this event today, is an instance of that debate. Yeah, this although it's not our event, but I'm very honored to be here, and this is actually the kind of situation we would like to see more and more, where we have such debates which are open to various questions, which are not afraid of difficult topics, and which engage various stakeholders. So I would start with this in terms of what's very important, and in terms of our strategies. I would say that global PSSL is that strategy. So when you look at the standard, it's quite holistic, because it's about alignment with those grand narratives, United Nations, the World Bank, the IFC, and so on. But it's also about working closely with our signatories and other contributors, being inclusive, but also about transparency. And within transparency, when you look at our principle, accuracy, we call for our signatories to provide accurate information about sustainable securities lending. And looking back at the presentation from David, that's excellent. I found it really exciting to hear about when you mentioned the standard term contracts, for example. In the legal field, you've had that debate for many years. Yeah, whether to what extent standard term contracts are fair, appropriate, and so on. And I think developing tailored approaches, even by smaller organizations, for other smaller or bigger organizations, is the way forward. Being dynamic, being forward-looking, and this is something that we advocate. When you look at our website, we've recently published several forward-looking recommendations and market standards, envisaging that future that also Roy is talking about. So that's what I would start with.
Radek, thank you so much. We're getting a nice stream of questions coming in now, and I want to share some of those with our panelists. I want to push one in your direction, Roy, if that's okay. How well are service providers meeting the needs of beneficial owners and buy-side lenders in supporting sustainable practice in securities lending? I mean, David made the point that existing lending providers may need to change. Do they need to change? And if so, how?
Yeah, well, look, I think that's part of the challenge, right? So, but I think fundamentally the question is, what do customers want, right? At the end of the day, that's why an event like this is important, because as you can see from the questions from the audience, there's quite a lot of non-securities lending, intermediary participants asking these questions. So look, I think part of it is TBD. We need to have some more clarity on what customers want so that the service providers can come up with solutions. That's part of it. But part of it is driving in expectations. So you tell your service provider what you want. I mean, a big part of what we end up doing is kind of really bringing insider insights into what can be provided, right? Because investors that are actually lending don't always know the functional capabilities of their service providers who, look, let's be honest, everyone is in this business for a scale game. And what you want to have is everyone be a looky-likey and be able to pile them high and sell them cheap. And the reality is that something like ESG just doesn't fit that. And I think what we need is technology-enabled solutions. Everywhere else we are in the technology world ends up being micro-focused applications that do what the individual person wants. And I think securities lending needs to reflect that. And it can only have that when we listen and engage with that wider community.
Thank you, Roy. Another question that's come in from our audience. Looking at fund manager stewardship code and PRI statements, there doesn't seem to be much in there about securities lending. Why does the panel think that is? And what do you think ESG or stewardship teams should be doing to improve things? I will throw that open.
Well, I'll take a starting shot and see what other people say. Look, to me, I think David hit the point earlier on. A lot of investors and fund managers think of this as a secondary activity. I don't think people have quite realized just what a fundamental role securities lending plays in the plumbing of the markets, from IPOs all the way through to secondary market trading and the liquidity providers through market making, and then in the end, price discovery, and even the operational issues. So unless you can appreciate that and then layer on top of that the challenge of greenwashing, where you need those activist short sellers to be attacked in the greenwashers, I don't think people appreciate it. That's part of why we need to have sort of the wider discussion. So I think it was missed not because of ignorance or arrogance. It's just a lack of understanding on the prioritization of it.
Thank you, Roy. A more direct question. Sorry, did somebody want to follow up there? Is that Radek?
Yeah, it's Radek. I think this is a very interesting and important question. I'm not going to answer this because I think it's PRI that could sit here and give us more insights why. But I can tell you one thing, that when we started working on PSSL, so back in 2018, we obviously wrote, when I led the working group, we had policy papers delivered by various stakeholders. I was writing myself those policy papers. And in one of them, we identified the gap here, that PRI and other principles-based approaches do not tackle or focus on securities lending to that extent. And this is why we have global PSSL. In addition, I think it's important to emphasize that one of the hedge funds approached me saying that we want to engage with global PSSL because you fill that gap, Radek. So, but however, in the end, to be honest, it's not about just being super confident we are covering things that others don't. I think in the end, it's also about collaboration. So I'm calling PRI to collaborate with global PSSL and vice versa. We are very open to collaborate with PRI. We are very open to collaborate and continue our collaboration with international organizations, regulators, and other agencies interested in transparency, securities lending, the green agenda, and greenwashing, obviously.
Thank you, Radek. That's great. We've got quite a lot of questions coming in, and we don't have a whole load of time. So I'm going to just ask for responses to be fairly snappy in responding to some of these. One question that has come in, and I have a quick follow up on the back of this. Does the panel feel that tax arbitrage has no place in a lending program from a governance standpoint?
Okay. That's probably that one. David, I'm happy to start that. Look, I think it's a fair question because tax arbitrage clearly is the case of, it's subject to a number of legal cases in Germany, and other countries are looking into it and engaged in it. But look, what people need to be very clear about is that, as with any tax rule, there are a set of criteria that qualify or disqualify tax advantages or disadvantages. And you need to be very clear that if market participants can benefit from tax differentials while complying with the criteria of any of the tax authorities, then they're entitled to do that. That's why you saw the European Banking Authority come out with their report to actually say European countries and the countries should work with the tax authorities, with the capital market supervisors, to ensure that tax arbitrage is conducted properly within their market. They didn't say it's a bad thing. It says it must comply with tax regulations. And I think that's the key thing. There's clearly potential for abuse, but tax authorities are not the naive entities that they were, in the last century when I started working in this. They're very cognizant of what can happen and what does happen. And you can see that they're really aggressive in following up, as with the cases in Germany. So it's right to be aware of it, but it's also important to understand that there are criteria that qualify you or disqualify you.
Thank you, Roy. Another significant one from the audience. Please, would you provide further examples of greenwashing associated with securities lending, apart from missing the stewardship responsibility of missing your vote? So I think the question is, beyond recalls and the voting process, give us some more examples of greenwashing.
So one example that I found yesterday, I need to be careful what I say. I was looking at the paperwork that supports a sustainable ETF that's out there, and in the prospectus, there's details of the lending program. In the annual report, there's details of the collateral. I saw collateral there that I did not necessarily think should be associated with a sustainable ETF. And I think that's probably where I'm going to draw the line in terms of what I say. I think you need to understand, if you're in an ETF, if you're in a pooled fund, if they are investing, if they have a securities lending program, what's going on in it, particularly if it is a sustainable pooled fund or ETF.
Yeah, look, if I can just add to what David was talking about, because I think it's important that the audience understands what we're looking for, so I think it's a great question. In fact, David and I engaged for the very first time a couple of years ago because I wrote a blog post that actually questioned the ESG credentials of another ETF and the claims that they were making, and sort of challenged securities lending to actually match some of the shortfalls of that they had suggested. So that's one example. Look, my partner wrote at Pierpoint wrote a blog this week where he examined. So it wasn't saying that it was not what it claimed to be, but he examined a green repo and added a series of questions. Does it satisfy this, this, and this? And one of those things was the use of the repo finances, was that for green purposes, right? And if you look at green bond initiatives, that's one of the key things is the proceeds need to be applied to green solutions. And so it is those sorts of questions that we need to ask about. So there's one thing to say, are companies making claims for their organization that they are ESG compliant or getting better, but it's also the markets that are producing products that people are buying, which is going back to David's point there. So it's both levels.
Building on that point and the audience question, quite a lot of the dialogue in recent times seems to have been around exclusion and don'ts. It's a case of, in some instances, don't lend if you don't feel it complies with your stewardship policy. Screening your collateral for eligibility according to an ESG collateral list. It may be screening your counterparties according to their greenness and their ESG activities. Is this practice of exclusion sustainable, one? And secondly, what does sustainable lending mean beyond that? What are the positive liberties, the enablers of sustainable securities lending, rather than just a list of don'ts?
I mean, I don't think exclusion is sustainable. I think, clearly I have been doing pensions work for a long time, and I've worked with a number of schemes who've been doing lending for a long time. I've seen schemes who don't want to do it. I've seen schemes who didn't want to do it start to do it. And I think the thing that we've reached now is that you need to be more flexible about how lending is done. You need to think how it fits in with your wider RI policy and your wider beliefs. So I think exclusions, Roy made the point about sector exclusions from a lending perspective, but from an asset management perspective, you might find a stock that in that sector you think is a good investment. I think it does have to be a bit more nuanced than that. And in terms of the enablers, the point's already been made about technology. We have all this great technology at our disposal, and I think we need to bring some of that to bear to solve this issue.
We're getting brutally short of time. Radek, I mean, I'll give you literally less than 1 minute, but I mean, some of these enablers are clearly embedded in your high-level principles there. How do you see that question from your standpoint? And please keep it very short, because I need 2 minutes to sum up.
Actually, thank you. It's even farther than our high-level principles, because we have a draft forward-looking standard on interconnected collateral, and I do encourage everyone to read that, where we say that dynamic approaches must be more available in the future, but you also need to connect with the broader sustainable finance. Coming back to our outward-facing global PSSL, it's very important. And on tax, we also have an emerging markets paper where obviously we emphasize the supportive tax element. So I also encourage you to read. But I obviously agree with what has been said so far.
Thank you. We've got a lot more to say, and there's a lot of questions, both from the audience and questions that I wanted to put to you. But apologies, we're going to need to start to bring things to a close. But thank you so much for your contributions. I do want to flag what is upcoming. I mean, this is the third in the third ESG webinar series organised by Solactive, but the first in the current series. The next one is taking place next Thursday, and that will be on the subject of EU carbon markets. So please, those that have attended today, make sure that you sign up for that also. There is also a third in the series which will be on the subject of biodiversity. So I shall certainly be tuning in, and I hope you'll also be keen to join us for that. So please do get registered. Next week we'll cover the mechanisms of EU carbon allowance markets, how these mechanisms work, and how this asset class can potentially contribute to a positive environmental impact. Minerva, I've also do provide a broad range of educational material, so please feel free to interact with them on the email address hello@minerva.info. Anyway, that's the housekeeping brought to an end. Thank you so much for all of our participants and contributors, but particularly thanks for you for joining us and for the excellent set of questions. Unfortunately, we didn't have time to get through the full list of questions that you've sent, but very perceptive. So thank you so much, and thanks to all of you. And good afternoon, good evening, wherever you are in the world.